Alright, today's bank is Dime Community Bank Shares. It's located in New York. I think it's got about 60 locations, and all of which are in New York, I believe, so very geographically isolated to New York. So the ticker is DCOM, like Dime Community, and then they've also got some preferred shares, which are at 5.5% fixed. So that could be an opportunity as well. But yeah, so let's take a look at how things have progressed over the past year. So we can see that for most of the banks that we've been looking at, the 1 year's been looked like this for the first half, where they've got it kind of an up and a down, and then sort of banks have veered differently after that, and this one has kind of stayed at the bottom of its trajectory over that time. And we looked at the bank last year, and we decided not to buy, and maybe that was a good decision. It looks like it's been pretty flat since then, and the reason is we felt like I believe the credit risk was too much, as well as the capital and liquidity risk at the time. So it'll be interesting to see if some of those things have turned around, or if it's still not a very good buy at this time. But if we look at some of the statistics, we can see an 11 PE ratio. I think that's a little high. That's about a 9% earnings yield. And we're usually looking for somewhere at least 9.5%, right now. The average bank is somewhere around there, up to about 11%. So I can see just from Yahoo Finance's statistic, maybe it's priced a little bit higher than what we might like to see. Pretty good dividend yield though, 5.10%. But if we come over, first we can also see, market cap. It's pretty small, or kind of on the smaller end of banks. We have 340 publicly traded banks in our population. They're usually somewhere between $500 million to about 1.8 billion market cap. So this is kind of on the smaller end. But if we come over to the statistics, we can see the price to book is 0.68. That's really, really low. Typically, I think we'll see somewhere, at least like 0.9. What would the normal price to book ratio be in our statistics here? Yeah, about 0.8 to about 1.05, something like that. So at 0.68, that means that perhaps it's really cheap relative to its book value, which may or may not be a good price or not. We'll just have to dive into the statistics, or dive into the financials of the bank, and see, are the risks worth taking at that price. But so you can see the return on assets is about 0.56. That's really, really low. Probably about half of where we would want it to be. Our typical bank is somewhere around 0.8 to 1.05 return on assets, so really, really low. So that would tell us, perhaps it's a pretty low profitability bank. Return on equity is pretty low as well. So we might be trekking down the path of a pretty low profitability bank, and then also pretty high price on those earnings. So but we'll only know once we start digging in. So going down to the balance sheet here, you can see we've got about $370 million of cash. That's pretty low. That's a little bit below 3%. So that's on the lower end of what most banks might have. So and also the securities here, about 850 plus 600 million. That's about 10% in total of the assets, and that's on the low end as well. So immediately I can maybe see that the bank is more than likely not as liquid as the average bank is. Maybe they can make up for that in other areas, but that is that, and so loans is about 80%, and that's higher than what we normally see. So it looks like they're a little more allocated toward loans and less allocated to the more liquid assets up here. So they might be a little bit less liquid than what the average bank is and what we would prefer, but they might be yielding a little more interest income because they have a higher allocation to loans, which have a higher yield. And coming down to the liability side, we can kind of do the same assessment. So they've got their non-interest bearing deposits, 2.8 billion. That's about 22%. Yeah, about 23%, which is pretty much an average of the range that we normally see and what we look for. So that's good. And then the debt is about the normal average range as well. So 773 and 200 coming from the FHLB, and then some subordinated notes. That's about 8%, which is about normal as well. So really the liability side of the balance sheet is very normal. So I would expect that the interest expense would be pretty average. And so now we can come down to the income statement. We can see if that's the case. Before we do that, we can also want to point out, the preferred shares here, which, a fair number of the banks that we analyze have preferred shares, but it's not, a common thing to see. So something to keep in mind, because that definitely kind of eats into the common shareholders' net income, which we can see on here, 1.8 billion that comes out of the common shareholders' money, So, starting with the interest income, 161 million. And that is about 5.15%. That's actually pretty low, as a percentage of assets. We're usually seeing somewhere around 5% for, over the past 6 months to a year or so for most banks. But, over the past quarter, we've been seeing interest yields being up to 6% and above. So this bank is still kind of locked into loans from back when interest rates are lower, or they're just not doing a very good job of selling the higher rates. And perhaps we'll know a little bit more about what's going on once we get into the footnotes. But I would say that the interest income there is not as much as what we would typically see for the average bank around this quarter. So that's unfortunate. And then the interest expense, 89 million, that's about 3%. And it's a little bit on the high end for, if you're comparing banks over the past year or so. Over the past quarter, it's sort of where we've been seeing things. So, perhaps that's sort of an average interest expense, but still, the lower interest income and the higher interest expense, gets us about 71 million of net interest income, which is 2.12%. And that's really, really low. We typically see somewhere around 3%. So, that's a really, really low net interest income. So maybe that's a lot of the source of the not being the lack of profitability in the bank that we saw might have been likely when we were looking at Yahoo Finance. But also coming down here to the non-interest income, we did a few adjustments here because we pulled the gain on sale of other assets out, and also kind of some of the fair value changes in equity and loans held for sale, stuff like that. Because we're trying to, whenever we're looking at this net income, we're trying to look at what's the normal repeatable earnings here that we could consider as sort of a projection going into the future. So this stuff's kind of either one time, or it's lumpy, or it could go one way or the other type of stuff. We pull out. So anyway, when we did that, it gets to about 8.4 million. And that's about 5% of the revenue, which is really, really low. It's about half of what we would normally C here, and I guess that's because they don't necessarily have insurance or wealth management or some of the trust services, some of the other stuff that we would see for the typical bank, and so they're, without those services, they're not making that extra revenue, and they do have a title service here, but it doesn't really add a whole lot to their income. So yeah, non-interest expense is 52.5 million, which is about 31% of revenue, which is pretty low. So that's helpful. They do have some lower than average non-interest expense. But anyway, so lower net interest income, lower non-interest income, and then lower non-interest expense gives us about, after income taxes and the preferred shares, gets us about 16 million. And 16 million, actually, sorry, so we took out some of the asset sales and change in fair value of equity securities, etc. So this is actually 13.9 once we take out this 3 million and this 0.8. So 13.9 million is really low. That's 0.41% of assets, and we're usually looking for something at least double that. And so we can say that this bank is a lot less profitable than the average bank. And then also, if we were going to look at the valuation as well, the market cap was about 764 million. So 13.9 million divided by 764 million gets us about a little over 7% earnings yield, which is really, really low compared to what we would the average bank is trading at now, and and what we would prefer to yield if we were going to buy one of these banks. So that's really, really expensive for the earnings. So as it is, I feel like it would not be a good purchase. We're looking to make somewhere between 9.5%, 11% at least on a bank currently, and so I don't think we would buy one at a 7% earnings yield. So, but we can continue to go through here and see if there's some kind of redeeming feature of the bank, and then make a conclusion there. But as we talked about, it's a really old bank. It looks like it was established in 1910. It's been in the New York area and probably pretty well known there. 60 branch locations. Yeah. So let's dig in a little further then. So getting past the accounting policies, comprehensive income and stuff. They talk a little bit about the preferred stock, and it's basically 5.5% fixed rate. So security, as is typically the case, they've got some mortgage-backed securities, and the CMOs that end up being the bulk of things. It's like 63%. And then the rest of it, they've got some treasuries here, which is about 22%, and then 11% corporates. And so that means, only about 11% of the securities portfolio comes with some some risk. And generally, the banks are, investing in the securities of other financial institutions. So, but yeah, so I believe the securities on the assets or on the balance sheet was about 10%. So then 11% of that of the securities portfolio comes with risk. So I could see there's kind of an immaterial risk for credit issues with that. So probably not a whole lot of digging into the securities that would be necessary to do. They of course have unrealized losses, as do all banks currently, because of the recent run-up of interest rates. So that's not at all unusual. And once we convert things to fair value, we'll be able to, make an opinion on, the fair value of the net assets of the bank and stuff. But as far as the repricing goes, we've got some term structure here in the footnotes for the financials. They put everything, or at least all the mortgage-backed securities and all that kind of stuff, into kind of one bucket. So it's hard to see the term structure of those because they basically don't have maturity dates for the securities themselves. So we'll be able to see a little bit more of the repricing timing when we look into the call report. But I mean, as it is, it looks like for the ones that aren't the mortgage-backed securities, most of them are within 10 years. There's not any that are above 10 years old, so that's good. And once we get into the footnote about the yields, we'll be able to see more of what they're yielding. But it's lately I've been seeing a lot of banks that have securities in the 10 plus, 15 plus years, which is that's not particularly good, especially if they're at the low rates that happened in the past 1, 3, 5 years or so. So because then they're trapped into those rates for 15 years, which isn't good. So anyway, it's nice to see maybe potentially some quickly repricing securities. But anyway, so let's get down into the loans and see a little bit more of what's happening there. So you can see we've got a little over $2 billion in business loans, and then $4 billion in multifamily, and then $3.4 billion in commercial real estate, and then a lower percentage in the 1 to 4 family. So we can see a lot of our risk boils down to the commercial real estate side. The C&I comes in a little bit on the high end of the normal average range of a bank, so it's within the range, so not too unusual. I feel like you can lump the multifamily with commercial real estate in together, even though they're a little bit different in the way that they're utilized. But so those two together is about 68% of the loans, which is pretty high percentage compared to most banks. We would usually see somewhere like 35 to 45% of the loan portfolio. So got a lot of risk concentrated in there. And once we get into the allowance and some of the credit quality, we'll be able to see how that affects the loan portfolio and the credit risk of the bank. But so we've got the allowance here, which it shows is $76 million, and that's 0.71% of the loan portfolio. That's pretty low. We normally see somewhere between like 1.10, 1.25%. So 0.71% is way below what we would normally see. So, I don't know how robust the loan portfolio is. But if it has an average quality risk within the loan portfolio, and we've got an allowance that is below average, then that's not good, because we would want, for an average loan portfolio, we would want at least an average reserve for it, right? So in this case, potentially they might be under reserved, in my opinion. So we can go down here and check the non-accruals and the past dues and classified loans and see where things stand with that. So they've got non-accrual, no allowance, non-accrual with allowance. So that equals about $34.9 million. And that's about 0.32% of loans, and that's pretty average. This, actually on the lower end of the average. So maybe potentially good credit quality here, at least when we're looking at the non-accruals. And then if we look at the past dues, we've got about $86 million, and that ends up being about 0.8%. And that's within the range that we normally see as well. It's on the higher end of the range, but it's within the range. So, past dues as a percentage of loans is maybe about normal. And we can see a lot of it's in the multifamily. So, and it's basically doubled since last quarter. Wow. So I wonder where the non-accruals were. Yeah, so all the non-accruals are sort of in the C&I, but then we're starting to get a lot of past dues and the multifamily, but they're sort of at the beginning stage of becoming past due. So 30 to 59, 60 to 89, and not quite in the non-accruals bucket just yet. So we might, this time period, not necessarily just specific to this bank, but like for banks overall, perhaps there could be, the multifamily segment is starting to show signs of cracks. I can't remember from the banks that we've looked at up to now whether, multifamily is a big part of the past dues or non-accruals, but that's interesting to see how, last quarter, the quarter ending December 31st, there was nothing past due. Now all of a sudden, in this quarter, the biggest bucket of past dues is multifamily. So that's something interesting to think about for when we're looking at other banks as well. I don't know if it's isolated to this bank or all banks, but yeah, that's concerning. So then we have collateral dependent loans, which adds up to about 17.9 million. And that's a really low amount. It's about 0.17%. That's below the range we normally see. So a pretty low amount of collateral dependent loans. Anyways, so what is interesting to see though is that there's been a lot of loan structurings, 109 million just in this quarter, and that's basically 1% of the loans have been restructured. It seems like. So that's not good. For the past several banks that we've seen, there's been a lot of restructuring of the loan terms, significant payment delay. So there might be some cracks entering into the market in relation to that, because I've seen quite a few banks with a lot of restructurings happen. But anyway, what we normally so in the past 12 months they've had 149 million that they've restructured. Most of them are current, but some of them are still past due. It looks like these are multifamily ones. Yeah, so I guess they restructured those multifamily loans, and then they're still not able to pay them. Ouch. Those are likely ones that will have to maybe be worked out. But I think, maybe that is evident in the classified loans as well. So the classified loans being substandard plus doubtful. So business loans, we've got about 87 million. 1 to 4 family, we've got 11 million. Multifamily, 96 million. Yeah, that's a lot. Yeah, and then 91 million from commercial real estate. Yeah, so in total, it looks like almost 300 million of its loans are classified, and that means that there's some sort of identifiable issue with the loan that makes it unlikely that the whole thing's going to be paid back. So so that's not good. That's a lot. So our reserve for loan losses is 76 million, but there's about 300 million of classified loans here. So it seems to me that they should have, most of the banks that we buy have that ratio of reserve to classified loans of somewhere between like at least 90% or 150 up to 150% is normally the range that we see. And so this bank has a reserve of 76 million on 300 million of classified loans, and that's That's pretty scary. That means that if it turns out, and it certainly won't be the case, but that all 300 million of these end up being defaulting on, and the whole thing is lost, then all those loans are written off, and of course that's not going to happen. But the average bank has a reserve to cover all this, and this bank doesn't. So that leads me to believe that the reserve should be more, in order to put it in line with the way that an average bank has its reserve set up, right? So I would say that the credit quality of this bank is poorer than the average bank. And we can make considerations about that in light of the pricing of the bank too, once we kind of get at the end. I mean, it could be the case that if they have enough earnings to cover any potential losses like that, or if the price of the bank is cheap enough to where it would be worth our while to buy it and take on that risk, then that would be fine. But as we remember, I think the earnings yield was like 7% or something. So I feel like I definitely wouldn't want to buy a 7% earnings yield and still have a risk that over $200 million might be written off in the next several years. And like I said, it's not going to be that much money, but there is that risk. So, and for a 7% earnings yield, that's not a risk that I'm willing to take. So, but we can kind of continue on and see what else is there. But I think so far, we've already decided that the earnings aren't enough to make this a viable, reasonable bank to buy. Also, the price on those earnings is too expensive, but also the credit quality is not at an appropriate place, or at least the reserve is not high enough to be a purchasable bank as well at certainly at this price. But anyway, so as we go on, we can look at the interest rate risk as well as the capital and liquidity risk and see if there's any redeeming factors there. But I don't feel like there could be anything else that could recover them from these risks and pitfalls that we've already identified. All right, so now we're down in the derivatives. We usually look at these in regard to the interest rate risk. If they can hedge the liability side of their balance sheet, cash flow hedge the liability balance sheet, so fix the interest expense on the liabilities that they have, or fair value hedge the asset side of their balance sheet, which would be convert fixed yields into variable yields. Those are the directions that I prefer to see, at least in this interest environment where rates are increasing, and you could reprice assets or liabilities at higher rates, right? So what they have that we can see is they've got 150 million of cash flow hedges, which if you were to read it, you would see that they're on debt. So that's great. It's based on the FHLB advances. So $150 million is fixing the interest expense that they have to pay, which is awesome. And then they also have actually 150 plus 200, so that's 350. And then they've also fair value hedged the loans. So they've basically put these in the direction that I would prefer them to be in. Even though these aren't necessarily big amounts, especially when they've got almost $11 billion of loans on their balance sheet, how much is $500 million going to help? But and then on the on the liability side of things, FHLB borrowings, I think it's about 750 million or so. So it's actually, maybe hedges about half of those, which that's probably very, very helpful. Anyway, so when we do our calculations on the repricing, interest rate repricing risk, we kind of enter those into the calculations we do to make sure the term structure of the assets and liabilities. All right, so now we're down into the fair value side, so we can see, convert everything from what it's carried at on the balance sheet to what its fair value is out in the market, and then sort of see, what's the fair value of the net assets of the bank. Basically, it's book value, but at a fair value, and then compare that to the market price as well as to some capital ratios and stuff. So if we converted the held to maturity securities and the loans to fair value, we would decrease the assets by about $600 million, which is about 50%. That's a pretty big amount. Basically half of the balance sheet's equity gets decreased when we convert things to fair value. And that's a pretty big ding. And then there's also some nominal changes in the liability side, but since they reprice a lot quicker than the loans and securities do, there's not a whole lot of difference there. So liabilities decrease slightly too. So all that together makes equity decrease by about 45%, and that puts basically a price to tangible fair value of net assets. It puts that at about 1.93 times. So if you bought the bank at the current market price, you would get the bank at 1.93 times its net assets converted to fair value, almost 2 times. Which, when you see a bank acquiring another bank, that's usually about the price that they pay currently. So it's it's not high or not low either. So it's sort of in the range that we normally see for most banks. So sort of an average price on the net assets of the bank. But if you take the fair value of the net assets, so the assets minus the liabilities at fair value, and you compare that to the fair value of its assets, basically an equity to common equity ratio, right? That ends up being about 4%, which is it's pretty low. We normally see somewhere between 5 and 7%, something like that. So the bank's capital, when you convert it to fair value, is a little bit less robust than what we might see for an average bank. So that might lead you to believe that there's maybe some drawbacks in the level of capital that they have with the bank. But there's some other things we can look at too, like the more traditional ratios, like the common equity ratio, tangible common equity, as well as the regulatory ratios, which we'll look at when we get to that. But here we have the FHLB advances, so it's the debt of the bank that they've borrowed from FHLB of New York, and they also have the ability to borrow another almost 1.8 billion, so that's helpful. But what they've got is 773 million, so some of it is reprices overnight, and then some of it this year. So basically all of this reprices within the next year. So that's a risk. Once it does, it'll reprice at a higher rate. And we did see that they had the cash flow hedges, which perhaps hedge about half of this, so that's helpful. So when the rates increase, we would see the hedges would keep them fixed for probably about half of this. And we've also got some subordinated debentures here, I believe about 200 million. Yeah, when you add these two together. And the first one reprices, I think, in 2025, and then, 2027. And then the second one reprices in 2025, so these are fixed to floating. And they've also, there was another 8K that came out, also a prospectus that came out, I think probably like a month ago or so. But they're raising some more. I think it was 65 million, 67 million, something like that. Some more subordinated debentures that I believe are fixed to floating as well, and the fixed rate is 9%. So that's basically almost double what the rates were for these. But so that's a really high yield. Yeah. But when these reprice in 2027 and 2025 and become floating, it will be up to that rate as well. So that's just kind of the market rate now. And so the next year when we look at this balance sheet again, we'll have maybe those 65 million of subordinated notes on there again, are yielding 9%. So that's a lot of money. Deposits are a lot cheaper than that. So really expensive funding source. Anyway, so they've got equity-based compensation plans, a lot of shares that could potentially be issued for them. But I mean, compared to the average bank, it's not a whole lot. I think when you add up all of the shares that could be issued, like this 361,000, 27,000, and so forth, it's only about 1.5% of the shares outstanding. So most banks will see somewhere between like 4 and 7%. So 1.5% is not too bad. Anyway, we're getting down into the MD&A now, and we've got a lot of statistics here that they prepared for us that can kind of corroborate what we've already talked about. Return on assets really low, 0.51%. Return on equity, about 5%. Net interest margin, 2.21. These are all really, really low profitability figures. So it really corroborates our analysis that this is a really low profitability bank. From the credit quality side, by just looking at this, non-performing loans as a percentage of loans, allowance per loans, it doesn't look so bad. But what this is not including is the classified loans, which we saw was just an enormous amount. So anyway, carrying on, we can get down to liquidity and capital resources. When we first started looking at the bank, we started with the balance sheet, and we saw that it was a pretty small amount of cash on the balance sheet. They also have a small amount of securities, not a small amount, just less than what the average bank has. So we can do a few more calculations to see whether that amount of liquidity is enough. What does off-balance sheet liquidity look like, all that stuff. So it's explained a lot in here, but we also do some of our own calculations. But they had $371 million of cash, and then about 45% of their securities are pledged, which leaves about $750 million of unencumbered securities. So 371 million cash plus 747 million of unencumbered securities gets us about $1.1 billion of on-balance sheet liquidity, and that's about 10% of deposits, and that's a little bit lower than the range that we normally see. We typically see somewhere between like 13 and 18%. So 10% is a little bit on the low end, but probably it's probably enough for an average bank to keep operating. And of course, it depends on when are the maturities for the loans happening, when are the maturities for the securities happening, stuff like that. But so liquidity's a little bit on the lower, on balance sheet liquidity is a little bit low on the lower end. But and then some other things to think about too is that is the off balance sheet liquidity. So they're able to borrow from the FHLB, and they've also got correspondent banks that they can borrow Fed funds. And so as we saw, there was 1.76 billion additional liquidity they can borrow from the FHLB. So when you add that to the on-balance sheet liquidity plus unencumbered loans that they could, potentially pledge as well. That puts them about 72% of deposits, which is kind of at the low end of the range, but it's within the range. So, not too bad. Perhaps they have enough liquidity and of capital, but they're all kind of at the low end of the range of the average bank. And in addition, we were talking about how when you convert everything to fair value, then that becomes a lot less. So all these ratios, like the on-balance sheet liquidity and potential borrowings from FHLB and all that kind of stuff, that's sort of at the carrying amount on the balance sheet. So when we convert everything to fair value, that really hones in actually what is the amount of capital truly that's on the balance sheet. And we saw that that was in a really poor place. So that leads me to think that the capital of the bank and its liquidity is a little bit poorer than that of the average bank. So something to keep in mind with along with the risk and profitability that we've already talked with of the other things. But also we can see kind of the regulatory ratios here. I usually look at the consolidated company because that's that's what we're trying to buy, right? So 8.5% for the leverage ratio is pretty low. That's below the range that we normally see. So, but wow. So looking at the rest of these, 10% common equity tier 1, all of these are below the range of the average bank. So, not only did we identify that maybe the liquidity and capital of the bank itself is below what we would want, also the regulatory ratios are below the average bank as well. They of course are above the amounts that are needed to be well capitalized. So, there's not any restrictions on some of the activities that they're allowed to do, for instance, pay dividends or merge with other banks, etc., as far as I know. And so, there's not risk there, but, the regulatory ratios are below that of the average bank. So we would want to pay a lower price for a bank like that, right? Then we wouldn't want to pay an average price for a bank that has worse capital or liquidity, right? So some things to keep in mind when we put it all together at the end. They do have $1.5 billion of shares that the board's authorized to repurchase. So those will that equals about 4% of the shares outstanding. So that's a pretty good amount. It's a good average amount for most banks, but that basically adds to gives us an extra 4% of earnings per share were we to buy the bank after they purchase them. But keep in mind they've got to potentially issue 600,000 shares, which would probably come out of this for the equity comp plans. But anyway, so off balance sheet, they've got a little bit of commitments here, but not a whole lot to really consider. I feel like we can, it's a lot of the loan credit quality stuff. We've really beat that to death, so I think we can just kind of keep going. Here's the analysis of net interest income. So I usually like to look at this so we can see how they're doing, what their yields are, what the average yields are, of the different types, and why. If we remember, they've got a really low net interest margin, 2.21%. And I believe we saw that the interest income was really low, and the interest expense was pretty high. So I can see a lot of why our interest income is really low, because the multifamily non-owner occupied loans, the loans themselves, like if you were to kind of like weighted average this, it ends up being like 5-something%, which is a really low yield. yeah, maybe like 5.25% or something. And a lot of the banks that we see right now are getting up to like 6% at least on average on their loans. So, I don't know why they've got such a low yield on their loans. Maybe it's because most of them are from several years ago when the rates were lower. And so that's really hurting the interest income side because that's most of their balance sheet, right? It was like 80% of the assets or so. So 75 at least. But yeah, so that's kind of keeping their interest income down. But they've also got some pretty high yields on, interest-bearing checking, money market, yeah, savings, 3.87%. Yeah, so those are pretty high. Although looking at these 10Qs lately, they've been getting higher and higher. But over the past year, the core deposits here would yield somewhere between like 1.5% and 2% or so. Now all of a sudden we've got almost 4% yields on this. So that's really, yeah. So you can see last year there was 2%, 2.5%. So the yields have really started to creep up, basically doubling. And then, so once you kind of average all that out, the interest-bearing liability is 3.83% as a whole. And that's, higher than what we've seen over the past year as well, which, was somewhere, up to like 2.73%, 3%. Yeah, so 2.5% last year. So that's really eating into, not only are the yields on the loans less, but we've got, more and more higher and higher yields on the liability side. So it's kind of squeezing them for a net interest margin of 2.21%. Yeah, because last year it was 2.74%, and that would have almost been in the range that we would have, felt like was enticing. But now it's just super unprofitable, getting squeezed on the net interest margin, which is really bringing down their net income. And as far as the interest rate risk goes, they've got, I can see that they're, looking at this chart right here, they're very liability sensitive. So as interest rates go down, net interest income, or as interest rates go up, net interest income goes down. So that means, that could be why they're getting squeezed on the net interest margins, because interest rates have gone up. So that means the liability side of their balance sheet, interest expense goes up as well. The yield goes up, but then the assets didn't go as much, and so that net income just kind of gets squeezed a little bit. And could be possibly what has happened. And if they're still in this liability position, that could be what continues to happen, right? What I can see is that, within the next year or so, they're in a repricing position that's about the average for a bank currently. So most banks are kind of sitting at this position. I sort of prefer more of an asset sensitive balance sheet, just because the general nature of banks is a liability sensitive balance sheet, over the long term. So I think, anything that can more match the assets to liabilities, given its inherent liability sensitivity, I think improves the risk of the bank. But as it is, they're about an average bank's interest income risk, and that's mostly if the securities, most of them, which is probably 60% of them, reprice greater than 5 years from now. So those are sort of locked into really low interest rates for a long period of time. The loans, 33% of them reprice within the next year, and that's pretty average. That's sort of the way that most banks are structured currently, is that, about somewhere between 25 and 35% of loans reprice within the next year. And I think that's why that we've got sort of an average bank's interest rate risk here. But most of the debt reprices within the next year, so 88% of it, and then a lot of the liabilities as well. So about 73% of the deposits reprice within the next year. So we've got, if more of the loans had repriced within the next year, this ratio would have been a little more asset sensitive. But as it is, the liabilities reprice within the next year. The liabilities reprice a little bit more of the liabilities reprice than what the assets do, which puts it in this position. But it's not outside the norm of what the average bank is. So I'm not gonna ding their interest rate risk here because it's pretty normal and average. Anyway, so we've made it to the end of this thing, and we talked a lot about things, and we can kind of sum it up and put it all together here. The profitability of the bank is probably half as profitable as what we would like to see in order to buy a bank. I think its return on assets was like 0.41%. And they're really getting squeezed on the net interest income, which is what's hurting their net income. They also don't have a lot of ancillary sources of revenue, like wealth management or brokerage or all that kind of stuff that would bring in some non-interest income. So they've really got a low amount of non-interest income. The non-interest expense is lower as well, but it's not enough to get them to a good profitability place. So, all that to say, it's a pretty unprofitable bank. It's not unprofitable, it's profitable, but not profitable, not in line with the average bank's profitability currently. And so, as far as the risks go, we saw that the credit quality, they don't have a whole lot of past dues or non-accruals, anything like that, but it almost seemed like it's the past dues and non-accruals are starting to kind of creep up. When you compare last quarter to this quarter, all of a sudden a lot of the multifamily stuff started to look a little like there were some cracks forming in there, and a lot of restructured loans like the TDRs that were restructured, and in hopes that then the customer would be able to pay them normally. But it looked like those that they had restructured were the ones that some of them were becoming past due as well. And then where you really see perhaps the issues is whenever you look at the classified loans, the ones that are substandard and worse, and you see that there's like 300 million of classified loans when their reserve is only 70 something million. So there could be in the future a time when there needs to be higher provision, or a lot of these loans need to be written off or worked out or foreclosed, whatever needs to happen. But that would definitely land on the income statement and make an already unprofitable bank even more unprofitable, right? So that's the risk that would be taken. From a capital standpoint, we saw that, I feel like they do have pretty good liquidity and capital, at least to continue as a going concern, right? But the capital and liquidity is a little bit less than what we would normally see for a bank. I think the on-balance sheet liquidity was like 10% of deposits, and the off-balance sheet, adding in off-balance sheet quality, off-balance sheet liquidity is 72%, and both of those are kind of at the lower end of the range what we would normally see, and so not that egregious. But when we convert everything to a fair value, the net asset ratio of assets at fair value is at 4%, which is pretty low, really low capital adequacy compared to what we see for most average banks. And I think a lot of that's because they've just got a lot of unrealized losses, not only in the held to maturity securities, but also in the loans, when we converted those to fair value. And I think changing it to fair value decreased the equity by 50%, which is above what we normally see. So, that's a big risk. So, I feel like that the capital and liquidity, maybe is almost adequate, but not quite as much as I'd like to see on the balance sheet. As far as interest rate risk goes, we talked about that. It was, I feel like the interest rate risk is about what the average bank is. I would have, preferred it to be a little bit more asset sensitive, or at least less liability sensitive. But, as it is, I think that it falls in line with how the term structure or the sensitivity, asset liability sensitivity is with the average bank right now. So this bank would not have be singled out in some poor performance if interest rates were to go up. It would basically perform in line with most of the other banks that are operating currently. So I don't think there's any concern there that would not be a concern for the banking industry as a whole. So anyway, so to wrap that all together, we need to compare that to the price, right? And looking at the market price, we saw that if we compare the company's earnings to the market cap currently, that's about a 7% earnings yield, which is super, super low. We're normally looking for somewhere, and most banks are currently priced at somewhere between 9.5% to 11%. So for an average bank, we would pay 9.5% to 11% earnings yield for that bank, an average earnings yield, right? But in this case, we've got the credit quality risk, we've got the liquidity risk, and the bank is way profitable, or way less profitable than other banks, and we're having to pay more money for those earnings. So I feel like this is just way overpriced. We've seen, at least just in the past couple weeks, several of the banks that we've looked at have had, reasonable prices for reasonable risk, and the way that this bank is priced, it is making us pay more money for this bank that has less earnings and higher risks than the other banks that we've seen the past few weeks. So I would say that it's not an appropriate buy, and either in the when next year when we take a look at the bank, hopefully they've shored up a lot of these concerns that we've talked about, or either that or the price is going to have to come down to make it make sense to buy these risks and these earnings. So anyway, that's my analysis and my thoughts on the bank. And so if you've got anything that you think is pertinent to add, definitely add to the comments, or message me if you'd rather do it in private. And I'd love to hear what you have to think and what you have to say. So just let me know. And thank you for listening.